We need to be prepared and locked and loaded because the refinance opportunities that came up were in short order. We're in a choppy, volatile, uncertain market, which means bonds will go up and down, expanding our money supply because the Fed has been restricted. I'm going to explain that. Credit card loans, car loans, those are short-term borrowing rates, and they are low right now. Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop.
Hey, it's KP coming to you live from Culver City. This is a midweek update, and I promise I'll get something out on Monday with the CPI and PPI recap. Probably recognize this outfit because it's the same as the one I did Monday night from my office, which is later than the moment I'm filming this. But happened to be in LA for some meetings, and so a lot going on this week, obviously with inflation and the Fed, and all kinds of stuff, and we'll get into all that. But I want to give a project update. I know this story of trying to create more inventory in the world. We're in the middle of Culver City where it's very densely populated. So, the major builders are not going to come in here and do a bunch of tract homes. Everyone's custom. So there's a lot of custom building out there. So what'll be interesting is later this week, building permits and housing starts will be out. And so that'll be something pretty cool to see if, there's a rebound. So anyway, this is a project we're working on. And this is one lot. And then this is the same size lot, but with two houses. So some gentlemen owned both lots. And what we ended up doing was we ended up taking this lot off their hands a little over 2 years ago. And they've got this one right here, right? And then this one right here. So my construction partner, Jason, that you guys have seen before, he helps lead the projects on all three of these buildings. So, and then if you guys recall, there's one we sold about almost 2 years ago as of October, and then a fourplex down the street. I would go inside the house and give an update. But if I do, it smells like lacquer in there. So they just did some urethane stuff. So we'll get a quick little update. And while I'm killing time here, I will say that the theme that I brought up on the Monday night video about the K-shaped economy, it's very interesting. You talk about the haves and the have-nots in our society, and are the wealthy propping up this economy? It's something I've been fearful of ever since I was a kid, growing up in modest means. That it's like you look at Europe and there's you have property, you don't. Either you're rich, wealthy landowner, or you're struggling. The kind of erosion of the middle class happens in Europe, and I don't think we're there yet in America. But obviously, it feels like it at times when it's so expensive to get a house. But all the Fed has to do is cut the rates, right? So they can help bring affordability back in with mortgage interest rates. So I understand the irony of me sitting in a house building construction projects in Culver City and talking about a K-shaped economy. It's not lost to me, but I didn't grow up with money. So we can all get it. It's the best thing about this country. So let's see here. Here's a floating staircase. And what's cool is there's like a wooden floating staircase up there for the third floor. And this area right here is our living room. Get the fireplace right here. And a kitchen. Butler pantry, and we got the sliding doors as usual right here. Good about that. We got a pool out back, little dipping pool. We got a boathouse. ADU, pool house, whatever. But it is livable. ADU is one of the greatest things about California and our regulations that allow that. So here's the pool. I'm dipping, so you're gonna get a chance to take a look at it. And it's about 6 feet, a little less than 6 feet. I'm at the water line here, so I'm 6 feet tall. So nice, cute little pool, pretty steep grade. Anyway, so retail sales is out Thursday. I don't have an update, obviously, on this video, but I'll try and get an update on all the CPI, PPI, and retail sales on my Monday night video. Short video. Have a good one. We'll get some more updates on the properties as they come to an end here. Got about 60 days left. And then hopefully the rates are a little lower, make it a little, make the buyer crowd a little larger. So it's a big risk building these things. But no risk, no reward. Cheers.
Hey, it's KP coming to you live from Corona, California.
Sorry, I just watched Becoming Led Zeppelin on the plane. This is the second time. I don't watch a lot of TV, but I had a plane trip yesterday, and gosh, I could. They're my favorite band. I could watch them over and over again. But you don't want to hear about my band. You don't want to hear about where I went. If you know, you know. Sorry I didn't get my video out last week. Okay, lots to talk about. It's Q2 earnings season, and I'll talk about why the flow of money, stocks, bonds, how it impacts, our mortgage interest rates, what the MBA's new forecast that came out on July 17th. I didn't hear anybody really talking about it too much, but we'll get into that. And of course, we'll talk about the CPI and PPI inflation breakdown. I won't get into too much of it. I'll try and give a different take on it because you guys have heard everything. But Chair Powell speaks tomorrow at like some economic conference. I don't know. What's he speaking at? The Fed banking conference. So, they're in the quiet period, so we can't really talk about monetary policy, but I'm sure I'll get to ask some questions. Okay. Everyone climbs a wall of worry. It's totally normal. It is okay. It's okay for you to have fear, uncertainty, and doubt, and to be bombastic and to have worst case scenario or have your emotions not in check. However, there's a difference between passion and climbing a wall of worry. So, I hear so much about the lack of opportunities, but I don't know if you guys saw. So the NBA forecast came out, and in Q1 there was $112 billion in refinances. Okay, and they're projecting for Q2 that there is going to be or was or will finally be measured. I mean, they put this out July 17th, and Q2 is already over. They have $182 billion. Okay, that's a lot of refinances. So that's a lot of date dumping for those that dated those rates. Now, of course, some of that could be equity lending. I totally get that, but it's still a refinance. It still counts. And so their projection for the year is still over $2 trillion, just barely, with about 1.357 trillion in purchase business, which we're like almost at, with the current run rate that they have right here, we're like 630 billion in purchases already done through the first 2 quarters. That's a lot. And then $664 billion in potential refinance opportunities. Now, so there's a lot of date dumping for people that dated rates. And Barry Habib did a good job of highlighting this. If you follow his daily podcast, vlog, whatever you want to call it, he spoke to our team last week. He was awesome. And he showed this chart that showed like, you have to be cocked and loaded and ready. Remember, we're hunter-gatherers. I get it. We're programmed to climb a wall of worry. We are, what's it, our cerebral cortex or whatever the lizard part of our brain that makes us, fearful and look around the corner and what animal is going to kill us while we're hunting and, hunt or be killed, whatever the thing is. And so originators, you need to be prepared and locked and loaded because the refinance opportunities that came up were in short order. We're in a choppy, volatile, uncertain market, which means bonds will go up and down. Some of these refinance opportunities that Barry highlighted in his presentation lasted a day or a couple days or maybe a week. And so you have to be able to communicate that to your borrowers, be ready to capture that. That's why AI matters. That's why having these tools that we have and everyone's starting to work on getting, it matters because you need to be ready to hunt and strike and pull the trigger. And so, having said that, I thought the GDP number that the MBA forecasting team put out was very interesting. So, I know we're not having this refi boom, okay, unless something sets in like a recession, like a legit recession. Well, MBA to the rescue. They have our Q2 GDP at 1.5, which we get the advanced reading, the first reading, next week. and they have Q3 and Q4 at 0.7 and 0.4%. So a recession used to be like 2 quarters in a row under 2%. 2% is trend growth, under is recessionary, above is expansionary. So 0.5 for the year of 2025 in the forecast, 1.5 for the entire year of 2026, and 1.9 for the entire year of 2027. Are we going to be in a recession for like the next 2.5 years? I don't think so. So the Fed to the rescue. So that was very interesting. They have inflation, about 3.2% this year, which Chair Powell will probably comment on, and CPI, which is a tier 1 data point. But remember, they look at the PCE, the personal consumption expenditure, and specifically core PCE, which does come out at the end of this month as well. In next week, which is the largest week for Q2 earnings season in the stock market, while this is the second largest reporting week of earnings season, which I will get into the flow of money in a second. So remember, the CPI index is 12 monthly reads in a row, and they throw out last year's. Last year's was a 0, which means everything was going to be higher. But, it came in, matching consensus. It rose 0.3% from May, which, of course, raises the headline number by 3 because it's replacing a 0 from last year. So it went from 2.4 to 2.7. But the core CPI is more important. And it excludes food and energy. It rose 0.2%, which is below the consensus of 0.3%. But wait, tariffs. We haven't talked about tariffs. I've gone this whole time without talking about tariffs and the wall of worry. Tariffs like the saber-toothed tiger when you were a gatherer hunter. The mythical beast. So, yes, home furnishings was up 1%. And there were some other things that were in there. And, I'm not saying it's nothing. And it could be the start of like a real trend. But like, do I have to buy home furnishings or appliances if prices go up? They'll just kill demand. That higher prices kill demand. So anyway, I just thought it was a really funny way to describe this in Mortgage News Daily. If you didn't already read this last week, if market watchers get out their magnifying glasses, they can certainly find some evidence of tariffs impacting inflation in various goods, but those goods are such a small part of the overall CPI calculation that they didn't account for any of this month's higher inflation. Rather, it's the usual suspects: housing, medical care, and financial services, professional services. So on housing, housing has been, it's been up, but then slowing the rate of increasing. So it's disinflation. It's not deflation. It's just disinflation. It's like coming in for a soft landing, which we've talked about. So it's Ivy Zalman, who I was introduced to personally by Barry Habib during COVID when things were kicking off. And ever since then, we've been giving them our data so they can have, fantastic reports, and love their research. They're now a Walker Dunlop company. And she said something that the housing component of CPI inflation, at 4.1%, the annual change failed to decelerate for just the second time in the last 26 months. So 24 last 26 months, that's actually been decelerating. So we've been seeing disinflation. So 2 years of disinflation. So 1 month of the usual suspect, which is housing, does not a pattern make. We have higher rates for longer. But on rates, the last 4 trading sessions since the CPI report have been improving rates, which was preceded by the 4 trading sessions with worsening rates for the fear of rates going to go up because the CPI was going to go up, because inflation was going to go up because of tariffs, which it didn't. So anyway, there's a lot of offsets to goods. Services inflation is coming down. Gas is coming down. We're importing deflation from China, who's having a mess of a time, which, by the way, I just kind of roll into the topic. Thank you, Greg Scher, for standing in for Courtney and Christy and myself with Brian View on The Last Word on Friday. I just had a chance to watch it a couple hours ago. It was really good. And you guys talked about the China thing, which I thought was interesting, or foreign buyers. So it made me have a thought that no one's really talking about. So California Association of Mortgage Professionals had their annual, their camp, and it was in Newport Beach. And so we came out in full force last Tuesday. And Robin Clayton, our performance marketing director, had a session, and Alex DeHaro and some of our AEs, Zia Morrow and Jim Martin, Carl was there, Marty was there. We had a whole team. So we came out in full force, wrote the check, did the whole thing. It was great. So at the exact same time as Rob in session, there was a Chinese bank that, gets a lot of foreign nationals. And I was talking to the rep, like, what's it like? It's pretty slow. Of course it's slow. It's a lot of foreign Asian money that typically comes in here, but China's hurting. Their real estate market's hurting. Like 70% of people's net worth in China is out of real estate. They're like knocking down condo buildings over there. So, they're having their own problems over there, Japan as well. So we're not getting as many foreign buyers, but even at 52 or 56 billion out of a $2 trillion year, it's a drop in the bucket. So my thought was, if you had a lender, anyone, I'm not naming names, or whoever you are, whatever the comments are down below, mom and pop investors take up more property. Not institutional investors. They're like under 3%, not like, all the different, investors that buy 1,000+ homes. Mom and pop investors like me, apparently, when we buy investment properties, which we do rehabs and then flip them. So we're not just buying investment. But if you want to give more back to your community for first-time home buyers to have a chance, just stop lending on investment properties. That is the key. That is the one thing you could just stop. So good luck telling your originators that. Okay, back to inflation. So PPI was flat. There was no producer price index, which some of those components funnel into the core PCE, personal consumption expenditure, next week. And so, that could be flat too month over month. So that would be nice backdrop heading into the Fed meeting next week, where they talk about not cutting, but when they might cut. I think they'll cut 25 basis points in September because we'll have enough information on the tariffs, uncertainty, and the wall of worry of the saber-toothed tiger. And then, of course, they'll have the dot plot to give them cover, so everyone can kind of get together and go, well, this is what they all said. They're dots, but no one's names, no one's saying out here. We came to a consensus as a board, and here's our dots. No names on there, of course. Anyway, retail sales was up 0.6%. Was supposed like the month before, it went down a full point. So, people who are fearful of tariffs will say, well, people are pulling forward more purchases in case prices. Okay, well, that means they're not going to buy in the future. That means demand will go down later. Okay. Or maybe the consumer's strong and they don't really care. And it didn't really show up. So you had high retail sales and not that big of an inflation report. I can't figure it all out, but I'm trying to figure it out. We're all in this thing together. And I could be wrong. Maybe there's this tsunami of inflation coming around the corner. I thought it was interesting that Huntington Bank shares out of Columbus, Ohio, bought Veritex Holdings, which owns Veritex Bank out of Dallas, Texas, I believe. Great people there. They offer a lot of warehouse lines for non-QM lenders in our business. Be interesting to see how that materializes. But I thought that was a great acquisition by Huntington. And cheers to all the Veritex people. Hope you have a lot of stock and you made a lot of money. I know a couple of you. Drinks on you next time. I think they're always on you. Earnings season and why it's important. That's the last thing I want to talk about real quick. Okay, so NVIDIA's an over $4 trillion company. $4 trillion. By the way, since Liberation Day, when their stock went down and I bought the dip, I told you all to buy the dip, and I've been in their stock since it was $6. Not a whole lot, but whatever. Just, I'm not a financial advisor. I'm not responsible for your losses, only your profits. But let me just say, they gained like $2 trillion in market cap since the April Liberation Day kerfuffle. And now they are securing a deal to lift restrictions on their company's China-specific H20 chip. Now, I think it's interesting. We actually want China to be on NVIDIA chips. It's not just chips that they make. It's the software platform that is used to then get next year's and the year after and all the different versions that keep getting exponentially greater compute power so we can create all this stuff. We want China to be on our software. It's like, hey, use Microsoft. Use Apple iOS. Don't go build your own stuff. We want them on NVIDIA stuff. Although, I don't really trust them. Government, maybe they'll just rip off the IP and go build it themselves. But that's good news. I'm not saying anything about the stock. I mean, it could be a buy on the rumors selling the news type environment. The stock market is highly extended at all-time highs. But it's every stock for himself. If they come out and say, Tesla comes out, Google comes out, if they come out and say the tariffs is no big deal, we're looking forward, here's what we're doing in the next quarter, we're going to stay on target for all of our analyst projections, I mean, 83% of companies are beating analyst estimates so far they have reported, and by a wide margin, by like 8%, versus the analyst estimates like 5%. So stock market's doing good. But if it's a little overextended and money starts to sell off, which seasonally August is kind of kind of a break in the stock market. Here sell in May and go away. Well, they didn't go away in May because the April kerfuffle made them have to stay in and buy a bunch of stuff after the dip and buy the dip. So maybe they can have a really double down banger in August. So anyway, let's watch rates. Have a good one. Cheers.
It's KP coming to you live from Corona, California.
We are on the crazy train. R.I.P. Ozzy. Died of complications of Parkinson's, which my father battled for 22 years and passed 4.5 years ago. It's a tough disease. And had a coworker in the office next to me who battled cancer, and she passed this week. R.I.P. Heather Skipworth. And one of my childhood friends and former loan officers battled ALS. So the three worst friggin' diseases out there. What a crazy train we've been on in life and business. And so we're going to try and pivot into some economic news. So Japan deal, $550 billion, and there's a 10% tariff on the money that gets invested by Japan, which will finance Japan. So they will tariff us. So basically, they will help finance investments in America, and America keeps 90% of the profits, and then Japan gets 10% RIP, which is way better than the Japanese yen is doing. The effective tariff rate on Japan, I believe, is 15%. I'm not sure. That's on things that we buy from them. UK got the best deal at 10%. EU deal, India deal, some of these other deals are forthcoming. So, it's impactful for our business because people are, I would say, unnerved with the tariff kerfuffle and everything and the uncertainty that it brings, especially when the Fed has come out and said they would be cutting rates right now had there not be tariff uncertainty that could cause inflation. So there's a lot of people I see online they're saying, without a doubt, no question whatsoever, tariffs will absolutely, no matter what, cause inflation to be passed on to the consumer. And that's not in all cases, and I don't know if that could be said for all cases. A lot of employers are eating those costs, Walmart being one of them. So that tax on billionaires that Elizabeth Warren has always wanted, it's happening now on multi-billion-dollar corporations. But the dollar is weak, and that has helped offsetting at least multinational corporations' cost to do business around the world. It's better for foreign countries when there's a cheaper dollar because then they can buy our stuff and we can sell more stuff over there. But that dollar may reverse and start going up if this economy strengthens. And so our GDP reads and everything that we'll be getting going forward, are we going to have growth this year? The One Big Beautiful Bill added $5 trillion to the debt ceiling. We already have a $39 trillion national federal debt, and we run a deficit. So, the flow of money matters because people are scared and have been off the sidelines. You saw it in the stock market. There's still $7 trillion of Americans' wealth, mostly held by boomers, on the sidelines in money market accounts, basically earning jack squat. So will it get into the stock market? The stock market's ripping. I'm not a financial advisor. I'm not responsible for your losses, only your profits. But, the stock market's probably a little bit overbought, and there's something called a CAPE ratio. It's one of Buffett's biggest indicators, and basically price to earnings is, one of the highest it's ever been in the stock market. So he would not be a buyer right now. And I'll talk about gold in a minute being treated as a tier 1 asset since 2017. He famously says, I don't like gold. It's just a lump of metal. You can't do anything with it. Aha. The goalposts had been moved, and as the Basel III Accords continue to get amended for capital and risk-based requirements for banks, not central banks, of course. They have their own FASBs, their own accounting rules they get to play by, more goalposts moving. But we shall see how it all lines up, and I'll get into some of the stuff on gold and the Bank of International Settlements in Switzerland, which is where the Basel Accords come from. But first, some housing news real quick, and you can tell your borrowers who are on the sidelines and afraid right now to buy. Now is a really good time to buy, and we need to make sure that we let people know that rates are not in a bad spot. The trend is for them to get lower generally from here in the long run. And so whether you say marry the house, date the rate, dump the rent, whatever, however you want to say it, now's a good time to buy for sure from a price standpoint because the median home price just hit an all-time high. I don't like using median home price that much as a home price indicator, but it's noteworthy at least because it's in the press all the time. Typically, the higher end homes, when rates are high, higher priced homes are much more expensive and less attractive. We saw an uptick in cash buyers last month from 28 to 29%. Usually a sign that there's a kind of a bottom forming in pricing, and usually a good sign that it's a good time to buy, even if you have to finance it. So existing home sales down, and new home sales last month slightly up. So we're at like 4.6.5 million units. We're pre-pandemic levels. So a normal market over time, not the one we've been used to since the pandemic, you have about a 6-month housing supply. And the good folks over at MBS Highway did a great job of highlighting that we have a 4.5-month supply, and the 1.5 million homes in inventory, 500,000 are under contract. So there's only 1 million homes that are active listings. And we know listings are seeing some price cuts at an unseasonable time. But I think a lot of people are coming out of the woodworks with existing homes and saying, okay, now's a good time to sell. And they put some stupid number out there because they don't listen to the realtors who know better. And so they either end up pulling it off the market because they weren't really going to sell unless they got that badass price, or they end up cutting because they didn't price it right the first time, as a good real estate agent would let them know. So originators and real estate agents, it's your job at the local level to continue to educate and say that now is a great time to buy. This year should have more overall volume than last year, even if units being sold are down. We all get paid on volume, not units. So units could be down this year from last year, but volume could be up, just like home sales could be down and median home price can be up. It is a crazy train. So make sure that we're communicating and not feeding into the fear and the frenzy that the media loves to put out there. That's why I just look at math, science, data, and facts, the only thing that matters. Okay, another really cool thing that came out of MBS Highway was the Kindleberger spiral. Kindleberger, check it out. Thanks for hanging with me there. A little Marco Rubio moment. It is basically what Lacey Hunt said on to the MBS team. It talks about liquidity in the system, and we talk about the flow of money. We talk about how we need money. We need money to grease the skids. Remember during COVID, we went to zero interest rate policy. Remember after the great financial crisis, we went to zero interest rate policy to have cheap flowing money. And I'm not advocating for zero rates, but the point of that was that we were so scared of outright deflation with our supply chains being constrained during COVID that we flooded the world with cheap money. So what's interesting is to reflate, obviously, the liquidity required to grease the skids of global economies, not just our economy. We need the Fed to cut the rates and expand the money supply. Having said that, the M2 money supply has been expanding since last year, even though the Fed's balance sheet has been coming down and interest rate yields have generally remained elevated, although they seem to have had a cap at the 4.4% 10-year yield level. As soon as I say that, we'll go above that and hit that next metric. But when yields go up, the price of the security, the treasury, goes down. It's an inverse ratio. So yields coming down actually raises the price and the value of existing treasuries that are on central bank balance sheets all over the world. And that's a good thing for liquidity. And so we need more liquidity. We need to have more liquidity in the world. The Fed balance sheet is under $6 trillion, or I think it's about to be, if not already there. I think I read 5.9. But if the Fed starts to put more money in there, it allows economies to continue to scale and grow. If we have stable employment and inflation is coming down and the tariffs are a nothing burger, or at least not that big of a deal and manageable. Remember, the Fed's conventional wisdom about tariffs in the history of history is that they're temporary inflationary shocks, but then they go away. And so how quickly will this shock go away, or if it will even materialize? Is there enough offsets with cheaper oil to offset the inflationary pressures that a tariff could bring. Yes, prices go up, but that doesn't mean that the demand is there for higher prices. So again, there's no gun to an American consumer's head to buy more expensive stuff. By the way, eggs, avian flu, those prices have started to come down because, we got through, culling all the hens. Cal Maine, big stock report this week, huge beat, record profits, and egg prices have come back down. We talk about the housing supply and we talk about the level of homes being sold between existing and new homes, and we're at pre-pandemic levels, which is where the Fed wants to get us back to. They think that that's kind of the normal bar of a normal market, and then we can set that as our base and then grow from there. We all know there's a lot of money out there. There's a lot of money on the sidelines. Boomer wealth, lots of cash, lots of help for down payments for people trying to get into homes, first-time home buyers, family members creating multi-generational wealth. We know that that's flowing in, and if rates come down and money gets less expensive in our business, we know that that will actually going to lead to more home price appreciation. We just know it. We don't have a lot of housing supply compared to the historical demand. So we're in the seasonally slow time, the back half of the year, with a pre-pandemic market with home sales and active listings and pretty generally, average rates over time. So we'll keep an eye on that. Okay, so gold being treated as a tier one asset is kind of important because you hear about all these risk-based assets and risk-based requirements for banks and what the Basel III Accords require for commercial banks, not central banks, to have. That matters because if they have the ability to use more cash to do other things other than just set it aside for reserves, that's good for economic growth. So it's not a new concept that gold is treated just like cash or a treasury, anything that's highly liquid. Remember, a deep, highly liquid capital market like we have in the United States is crucial, and the dollar is still king, and our consumer is still king. So, there is a Swiss bank called the Bank for International Settlements. There are 63 members, including every major central bank, the Fed, ECB, People's Bank of China, Bank of Japan, and 59 others. They're kind of a mediator. Like us and China wouldn't deal with each other and make settlements when we're trading our, they're buying our dollars so they can, which they haven't been buying as much lately. But you have this, neutral country with this enormous, central bank for central banks. So if you hadn't heard of that, look up the BIS. Thought that was pretty cool. It was born after the crash of 1929. And then, of course, after the S&L crisis, savings and loan crisis in the 80s, 1988, Basel I Accord, Basel, Switzerland. These are the requirements for banks and how much reserves and funds and everything they need to have on the books. Grouped bank assets by risk. There's different tiers. Like when you get over 100 million in assets, you're a totally different level of tier. We saw a couple banks blow up recently, like New York Community Bank, when they got over 100 billion in assets. Basel II came out in 2004, added some more risk, requirements and disclosures. Of course, that was after the 01 dot-com bust. And then Basel III came out in 2009 after the 2008 crisis. Since 2017, gold has been a tier one rated asset, but only if it's unallocated gold, which is why this whole thing about marking to market in the United States, all of our gold that we have, the physical gold that we have in Fort Knox, it's not just auditing what's in there, is the gold in there, it's whether it's allocated or not. So let's say you have a house, you have this asset, and you own it free and clear, and you take a cash out lien against it. You can do that with gold. Banks allocate credit based on their gold reserves, which is great. They hold it in their vaults, and then other banks can borrow against other banks' gold without having to keep the gold in a vault. It's much easier. But if you have unallocated gold, you get a 0% risk rating, according to Basel III since 2017. And that's just as good as cash. If you have allocated gold, you have like an 85% risk rating, which means you have to have assets to, reserves on top of your gold that's allocated to a creditor that's a loan out to someone else. So I thought that was pretty fascinating. The flow of money, ups and downs, how it all goes. Is there anything that I missed in my notes that I took over the week? Nope. That's it. Gotta hope nobody dies this weekend. Let's just cruise into the weekend and pray for peace around the world. Did you see President Trump and Chair Powell roaming around the halls in their building. Pretty entertaining. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.